I think this employment question is so important, particularly when you consider that the consumer sector, consumer discretionary, has been the biggest gainer in the S&P 500 over the course of the last month. And by a margin, if you could take a look there, more than 7.4% higher. If the labor market starts to weaken, and it's not just Tesla, I took a look, guys, it's like Norwegian Cruise Lines and other big consumer stocks. If the labor market starts to weaken, does that trade unwind?
I think if the labor market starts meaningfully weakening, I think some of these sectors can certainly feel a bit of weakness. And I also think that one of the areas, and we've talked about this here, one of the areas that has done really well is small cap stocks. And they've sort of gotten this push behind them because of rates becoming lower, coming lower. I think that's the area that I would be most cautious of going into the next couple of months. You know, Matt, you point out that, look, markets are at all-time highs, 41st all-time high, etc. And seasonally, September and October has seen a little bit of volatility, especially on election years. I think it's okay for investors to think about strategies that protect their downside for those looking for that protection. I think overall, history tells us that in cutting cycles, when the economy is fine, and, you know, we talk about this in our outlook as well.
There aren't very many cutting cycles when the economy is fine,
when
right?
They
cut
happen,
the economy's in trouble.
Absolutely. But when they happen, and let's hope this is one, equity markets over a 12-month or even a 6-month period tend to do very well.
Right.
But that doesn't mean the next 6 weeks or the next 8 weeks will be a straight line up. So for those investors that are looking to sort of protect their downside, there are so many ways in which they can do that with minimum volatility strategies, with buffered strategies, or, you know, just stay high up in quality. And the area of the market that we like the most is really focusing on clipping coupon in the bond markets and in that intermediate belly of the curve.
Interesting. Not in cash, but in the belly.
Exactly. So we've been talking about how stepping out of cash, as difficult as it may feel, especially when yields were at above 5%, which certainly isn't the case anymore. We've talked about how these pause periods are really ripe and fertile for investments into high-quality equities and bond markets. Even though the rate-cutting cycle has now begun and is going to continue in our view, that doesn't mean that you can't have positive gains from equities as well as from bond markets. So we're still getting opportunities to clip 5.5% coupon without taking a huge amount of duration or down in quality risk. And I think that is the opportunity here.
And, you know, at the end of the day, do you think that there's better opportunity here when it comes to equities or bonds? Because if you can kind of play it safe and go into the belly, then why take on risk at all-time highs?
So I think that certainly, given what we're getting in the bond markets right now, so if you're allocated to something like BINC, which is the BlackRock Income Fund, you have heard of that, yes, I know.
Special.
Exactly, but you can clip sort of 5.5–6% in some of those funds if you're looking at something even like in, you know, just looking at IEI, which is just 3 to 7 year treasuries, again, getting 4%. So I think there are some ways in which you can bolster your portfolio. I do think the Fed brings that negative correlation back. The idea that they are there if the economy falters and they're not afraid to cut aggressively brings negative correlation back. But you don't need to take a lot of duration risk because you're not being paid to. So stay in the belly, clip your coupon, and I think that makes for a really robust portfolio.